right, so ready to ditch those. Make $10,000 a month passively, daydreams, and actually like get real about investing. We've got some solid insights here that I think can help people turn, that $1,000 in a dream into a portfolio that actually like works for you, not against you.
It's fascinating how much misinformation is out there, and this deep dive really cuts through that and focuses on what you can actually use, starting with, the very first dollar you invest.
Okay, cool. So let's unpack this whole myth, right? Like, do you actually need a small fortune to get started with investing?
Not at all.
Okay.
Really, what's important is building a system,
right?
Not chasing those get-rich-quick schemes.
Okay, so what does a solid investing system look like for somebody just starting out?
Well, these sources highlight the power of passive income. And one of the most accessible entry points is dividend stocks.
Dividends. That's where you own a piece of a company and they pay you.
Yep.
Just for being an owner.
Exactly. Think of it like this.
Okay.
You buy a share of McDonald's, and every quarter they send you a little check just for holding on to that share.
I like the sound of that McDonald's paying me for once.
But there's a catch. Just because a company offers a high dividend yield doesn't automatically make it a good investment.
Gotcha.
We need to dig a little deeper.
Right.
Look at their overall financial health.
So it's about more than just chasing the highest payout. What are some of the red flags to watch out for when evaluating dividend stocks?
One key metric is the payout ratio.
Okay.
And that tells you what percentage of the company's profits are being paid out as dividends.
Okay.
A very high payout ratio could mean the company is stretching itself thin.
That makes sense. Yeah, it's like someone giving away all their money and not saving anything for a rainy day.
Exactly.
Okay, what else should we be paying attention to?
You want to look at their dividend growth history.
Okay.
Is the company consistently increasing its dividend payments over time?
Right.
That's a good sign of stability.
Gotcha.
And future growth potential.
Okay, so steady and consistent wins the race.
Yes.
But what if you're interested in real estate, but don't want the hassle of actually owning property?
That's where REITs come in.
Oh, REITs, okay.
Real estate investment trusts.
Okay.
Offer a way to tap into the real estate market without dealing with leaky faucets or tenant drama.
Yeah, sounds like a much more hands-off approach.
Exactly.
Yeah.
REITs own and manage income-producing properties like shopping malls, apartment buildings, or office spaces.
Great.
And here's the interesting part.
Okay.
They're legally obligated to distribute 90% of their taxable income to shareholders as dividends.
So with REITs, you're almost guaranteed a consistent stream of passive income. Do any specific examples stand out from the research?
Two interesting ones are Simon Property Group, which focuses on shopping malls, and Annaly Capital Management, which invests in mortgage-backed securities.
Okay, so those are REITs, but the sources mentioned a bunch of other passive income streams too, right? Things like crowdfunded real estate and peer-to-peer lending.
Yeah.
I have to admit, some of those sound a little intimidating to me.
It's true that alternative investments can seem complex.
Right.
But what's important is to approach them with a healthy dose of skepticism.
Right.
And do your due diligence, understand the risks involved, and don't be afraid to ask questions.
Yeah. It's like anything else with investing, knowledge is power.
Exactly.
But amidst all this talk of stocks and real estate, I'm curious about something the sources mentioned. Investing in yourself. How does that fit into the equation?
It's arguably the most foundational investment you can make. Acquiring new skills or honing existing ones can unlock opportunities for career advancement or even help you launch your own income-generating ventures.
So it's like laying the groundwork for future financial success.
Precisely. The more you invest in yourself, the more equipped you'll be to navigate the complexities of the financial world and make smarter decisions with your money.
I love that it's almost like a prerequisite for building true wealth.
Yeah.
But speaking of money, the sources also had some pretty eye-opening things to say about banks and saving strategies.
Right.
It's almost like they're letting us in on some secrets the financial institutions don't want us to know.
There's definitely a need for more transparency in the financial world.
Right.
And these sources empower you to become a more informed consumer, questioning assumptions, and seeking out alternative options that might better serve your financial interests.
Okay, so spill the beans.
Okay.
What are some of these secrets banks don't want us to know?
Well, for starters, you have more negotiating power than you might think.
Really?
Did you know you can often negotiate lower interest rates on loans or credit cards, or even lower your monthly bills by simply asking?
Wait, really? I've always just accepted whatever rates and fees they throw at me.
That's what they're counting on.
Oh, gosh.
But being proactive and advocating for yourself can lead to significant savings over time.
So it's about being informed and not being afraid to challenge the status quo.
Exactly.
What other bank secrets should we be aware of?
The sources highlight the importance of shopping around for the best rates on everything, from savings accounts to mortgages.
Okay.
Don't just settle for the first offer you get. Explore your options and compare rates at different institutions.
That makes a lot of sense.
Yeah.
It's like comparison shopping for anything else. You wouldn't just buy the first car you see without checking out other options.
Exactly. And speaking of shopping around,
Yeah.
consider exploring online banks or credit unions.
Okay.
They often offer better rates and lower fees than traditional brick-and-mortar banks.
So it's all about being proactive and doing your research.
Yeah.
But even with the best savings strategies, it feels like it takes forever to build a substantial nest egg.
That's where the magic of compounding comes in.
Okay.
This is where things get really interesting.
All right, let's talk compounding. I heard it's the key to building wealth, but I'm not sure I fully grasp how it works.
Think of it like a snowball rolling downhill.
Okay.
It starts small, but as it gathers more snow, it grows bigger and bigger, gaining momentum along the way.
Okay, I can visualize that, but how does that translate to my money?
Compounding is the process of earning interest on your initial investment and then earning interest on that interest. And so on.
Right.
It's essentially interest earned on interest.
Gotcha.
Creating a snowball effect that can lead to exponential growth over time.
So the longer you let your money compound, the faster it grows.
Yes.
That sounds almost too good to be true.
It's not about getting rich quick.
Right.
The power of compounding is a long game.
Gotcha.
It's about patience and consistency.
Right.
The sources use a powerful illustration. If you could double a penny every day for a month, you'd end up with millions.
Wow, that's mind-blowing.
Yeah.
It really highlights the importance of starting early and letting time work its magic.
Absolutely.
But hold on, we need to break down the different types of compounding, right? It's not all about savings accounts and index funds. There's also this thing called active compounding, which sounds way more exciting.
Yeah. With active compounding, you're putting your money to work in a more hands-on way.
So you're not just passively waiting for your investments to grow.
Right.
You're taking like a more proactive role in making that growth happen.
Exactly. You're actively seeking out opportunities to multiply your money, not just letting it sit there and accumulate interest.
That sounds a lot like entrepreneurship to me.
It absolutely can be.
Okay.
Starting a business is a prime example of active compounding.
Yeah.
You're investing your time, energy, and resources into building something with the potential to generate significant returns.
But starting a business is inherently risky, right?
Yeah.
There's no guarantee of success.
There's definitely a higher level of risk involved compared to passive investing.
Yeah.
You're putting more on the line, both financially and emotionally.
So what are some of the rewards that might entice someone to take on that added risk?
Well, for one, the potential returns can be much higher than with passive investing. If you hit it big with a successful business, you could see exponential growth in your wealth.
Okay, so the potential upside is huge, but it takes a certain kind of personality to thrive in that high-risk, high-reward environment.
Absolutely.
Yep.
Active compounding is definitely not for everyone. It requires a certain level of risk tolerance, a strong work ethic, and a willingness to put in the time and effort.
What about flipping real estate?
Yeah.
That sounds like another classic example of active compounding.
It is. You're buying properties, renovating them, and then selling them for a profit. Okay?
It requires a keen eye for deals, an understanding of the real estate market, and the ability to manage projects and contractors.
It sounds like a lot of work.
It can be,
Right.
but the potential rewards can be substantial.
Okay.
If you're skilled at finding undervalued properties and adding value through renovations, you can generate some pretty impressive profits.
So we've got active compounding on one side of the spectrum, which is all about taking a more hands-on entrepreneurial approach to building wealth.
Yeah.
What about the other side of the coin?
Okay.
Let's talk passive compounding.
With passive compounding, you're essentially letting your money work for you in the background
Okay.
with minimal effort on your part.
That sounds much more my speed,
Yeah.
less stress, less work,
Yeah,
but hopefully still decent returns.
exactly. Index funds and REITs are excellent examples
Okay.
of passive compounding in action. With index funds.
Yeah. You're investing in a diversified portfolio of stocks that track a specific market index.
Right.
Like the S&P 500.
So instead of trying to pick individual winning stocks,
Right.
you're basically betting on the overall growth of the market.
Right. It's a low-cost, low-maintenance way to participate in the stock market's upward trajectory. And we've already talked about REITs,
Yeah.
which offer a way to invest in real estate without having to deal with the hassles of property ownership.
And the beauty of both index funds and REITs is that they tend to offer relatively consistent returns over the long term.
Yeah.
But does that mean the potential returns are lower
Yeah.
compared to those high-flying active compounding strategies?
Generally, yes. The trade-off for lower risk and less effort
Right.
is typically a lower potential return.
So passive compounding is a good option for people who want to build wealth steadily over time without taking on too much risk.
Yeah.
Or spending all their time managing their investments.
Precisely. It's a great choice for those who prefer a more hands-off approach
Right.
and are comfortable with the idea of slow and steady growth.
But what about those penny doubling examples we talked about earlier?
Right.
Doesn't that suggest that compounding can create massive wealth relatively quickly? I'm getting mixed messages here.
Remember,
Yes.
the penny doubling illustration is just that, an illustration.
Okay.
It's meant to highlight the power of exponential growth over time, not to be taken literally
Okay.
as a realistic investment strategy.
Okay. So it's more about understanding the principle of how compounding works, not necessarily expecting to turn a penny into $1 million overnight.
Exactly. The key takeaway is that the earlier you start investing and the longer you let your money compound, the more dramatic the results will be.
So whether you choose active or passive compounding, the most important thing is to start investing as early as possible.
Absolutely.
Time is your greatest ally.
Couldn't agree more. The sooner you put your money to work, the more time it has to grow and multiply.
It's like giving your money a head start in the race to financial freedom.
That's a perfect analogy. And the longer you stay in the race, the further ahead you'll get.
But let's get down to the nitty-gritty here.
Yeah.
How do you actually choose between active and passive compounding?
Right.
They both have their pros and cons, and it sounds like it really boils down to personal preference.
The best approach for you
Yeah.
depends on a variety of factors,
Okay.
including your risk tolerance, time commitment, financial goals, and even your personality type.
So someone with a high risk tolerance and a lot of time to devote to their investments might be more inclined towards active compounding.
Exactly. They might enjoy the challenge and excitement of starting a business or flipping properties. They're willing to roll up their sleeves and put in the work.
While someone who prefers a more hands-off approach and values stability might be better suited for passive compounding.
Absolutely. They might be more comfortable with the idea of steadily investing in index funds or REITs over time, knowing their money is growing steadily in the background.
It sounds like there's no one-size-fits-all answer. The best strategy is the one that aligns with your individual circumstances and goals.
That's right. The best way to decide is to carefully consider your own individual circumstances and preferences.
Yeah.
What are you passionate about?
Yeah.
What are your strengths and weaknesses?
But what if you're someone like me
Yeah.
who enjoys aspects of both approaches?
Right.
Is it possible to blend active and passive compounding?
That's actually a very astute question, and it leads us to one of the most insightful points highlighted in these sources.
So tell me, what is this insightful point the sources brought up?
Yeah, it's not necessarily about choosing one path. like active or passive.
Right. Okay.
You can create a hybrid strategy that combines the best of both worlds.
Okay. I like where this is going. So how would that work in practice?
Imagine building a balanced investment portfolio.
Okay.
You might start with a solid core of passive investments, like those index funds and REITs we talked about.
Uh-huh.
They provide that steady, long-term growth, almost like a financial bedrock.
That makes sense.
Yeah.
Yeah. Kind of like setting a strong foundation
It is
for your financial house.
And then you can sprinkle in some active investments depending on your risk appetite and how much time you want to dedicate.
Yep.
Maybe you launch a side hustle that aligns with your passions,
Mm-hmm.
or you dip your toes into the real estate market with a rental property.
So you're essentially creating a personalized investment strategy that reflects your individual goals and risk tolerance.
Mm.
You get the stability of passive income streams, but also the potential for higher returns from those more hands-on active ventures.
Precisely. It's all about tailoring your approach
Right.
to fit your unique circumstances.
Right.
There's no one-size-fits-all formula
Right.
for success in the investing world.
That's actually really empowering.
Right.
It means you have the flexibility to create a plan that feels right for you, not just follow some generic advice.
And one more crucial point the sources emphasize.
Okay.
Don't get caught up trying to time the market
Right.
or chase the latest investment fads.
Wow.
It's about building a sustainable system
Yeah.
that allows you to grow your wealth over time, no
Wow.
matter what the market is doing.
So slow and steady wins the race.
Exactly.
Yeah. Okay.
Consistency and patience are key. Now, pulling back to the big picture,
Yeah.
what do you think are the most valuable takeaways from all this for our listeners?
I think it boils down to this. Building wealth is a journey, not a destination.
Yeah.
It's about educating yourself, making informed decisions, and staying committed to your long-term financial goals.
I couldn't agree more. Whether someone leans toward active compounding,
Yeah.
passive compounding, or decides to create that hybrid approach,
Right.
the most important thing is to take action. Start today, even if it's with a small amount.
Yeah, that recurring theme of start small, stay consistent, and keep learning
Yes,
really seems to underpin all of these investing strategies.
absolutely. It's never too late to start investing in your future. And remember, even small, consistent investments can lead to significant growth over time, thanks to that magical power of compounding.
This whole deep dive has been incredibly eye-opening. I'm feeling motivated to get my own financial house in order
That's great.
and start making my money work harder for me.
That's fantastic. Remember, it's not just about picking stocks or buying properties.
Yeah.
It's about shifting your mindset, embracing a long-term vision,
Right.
and really taking control of your financial future.
And for our listener out there, we leave you with this final thought.
Okay.
What will you invest in today to create a richer, more abundant tomorrow?